In today's video, you'll see part 2 of my interview with certified financial planner professional Brent Bowden, in which we discuss 2 reasons why I prefer Index Universal Life over Whole Life.
Just talk a little bit about the difference. There's tons of different types of cash value life insurance policies. Why do you like the IUL over kind of the older whole life policy? And what makes that different? Obviously, there's also variable ones out there for people who want to be a little riskier, but the IUL tends to be one that I like a lot for some features. But what's your opinion on that?
I like the IUL over, say, whole life, and I've got a lot of people that read The Power of Zero who utilize whole life. So I'm not historically been one to dump on whole life. I think it has a place. But one of the issues with whole life are the loan provisions. So the question becomes, how do you get money out of these policies tax-free? And the reality is the best way to do it is by way of what we call a policy loan. And basically what you're doing is you're taking a loan from the life insurance company. They're charging you a rate of interest. And at the same time, the insurance company is taking money out of your cash value and they're putting in what I call a loan collateral account. And they're they're crediting you a rate of interest. So you've got 2 sides of the ledger here. You got the insurance company that's charging you a rate of interest, and then they're crediting you back a rate of interest in the money that's been placed into that loan collateral account. I've seen life insurance policies where they charge you they charge you 8%, but they credit you back only 4%. So in other words, there's a net cost of borrowing of 4%. And that doesn't seem like a big deal, but that interest grows and compounds over time. And if you don't pay that interest back at the end of the year, they subtract it from your cash value. And then the next year you take another loan, they charge you another 4%, but you haven't paid back the loan from the first year. So now you're paying the interest from the first year and the interest from the second year, and that snowballs and compounds to the point where it could really force you to run out of money in your life insurance policy 10 to 15 years faster than you were anticipating, at which time you get this tax bill and you lose your death benefit. So it can be really bad. It's like getting divorced. A lot of bad stuff happens when you get divorced. You don't want this to happen to your life insurance policy. So I make the case that the only time you should really be married to a life insurance policy, for the rest of your life, is if you have a 0% loan provision. Now, I got to warn you, some companies out there say we'll start you at 0, but we reserve the right to change it to 1, 2, 4, or 8 when at our leisure. That's no good either, because if you give a life insurance company 40 years to make up their mind, their fox is in your chicken coop, and I can guarantee that at some point in time they're going to change things in their favor. So I really prefer LIRPs that have a guaranteed 0% loan, ironclad loan provision. It's guaranteed in the contract. They can never ever change it, because you want that loan provision to be tax-free and cost-free. All loan provisions are tax-free, but they're not all cost-free. And so the devil's in the details when it comes to those loan provisions. And IULs IULs with certain carriers have guaranteed loan provisions, 0% loan provisions. Whole life policies do not. And if the goal is to build money up so that somewhere down the road you can take it out and spend it on your lifestyle at a period in time when tax rates are likely to be dramatically higher than they are today, then the loan provision really becomes almost the most important provision in the entire contract, because it determines how much of your money you can get and at what price. So that's why I like IULs, particularly IULs that have guaranteed 0% loan provisions.
And I think another provision that I always like to talk to potential clients about is just medical professionals are very busy. They're moving all the time and don't have a ton of extra time to do some of that legwork. And market volatility is another thing that comes into play for them, managing as many risks as they can. I think an IUL does a great job of it, in contrast to some of the other cash value life insurance policies.
Yeah. So what does the IUL purport to do? The IUL purports to give you exposure to the upside of the market with a guarantee against market loss. It's nothing exotic here. So you're getting exposure to the upward movement of a stock market index, say the S&P 500, and you have a guarantee that you won't lose money as a result of the market. Now, you may have a flat year in which the market went down and they credited you a 0, but they still take out the insurance expenses. So you're not guaranteed to lose money, in any given year, because you could have a 0% credit and they're still taking out the insurance expenses, but they guarantee that you'll never lose money in the market. Okay. And so, what sort of rate of return might someone be able to expect in their IUL over the course of a lifetime? Well, it's not going to be stock market like returns. It's going to be bond like returns. And what I typically tell people is between 5 to 7% net of fees over the life of the program. Well, guess what? If you can get 5 to 7% net of fees without taking any more market risk than what you're accustomed to taking in your savings account, that's a pretty safe and productive way to grow at least a portion of your portfolio. Now, let's go back to your doctors and your healthcare professionals that are growing money outside of their retirement plan inside that brokerage account. And they're in a high marginal tax bracket. Let's assume they could get a 6% rate of return in their IUL. What rate of return would they have to get in their stock market portfolio in that taxable bucket, assuming it's all short-term capital gains? What rate of return would they have to get in that bucket to be able to eclipse that 6% rate of return in the IUL? Well, you do the whole thing where you divide 6% by 1 minus their marginal tax bracket, and that gets you to somewhere on the order of 9%, okay, for these people in the higher marginal tax rate. So in other words, if you were to have the choice between an IUL versus growing money in a stock portfolio in your taxable bucket, your brokerage account, what rate of return would you be required to get to, in the end, net more money than you would if you just invested in IUL? You'd have to get 9%, and you have to take all the risk commensurate to that 9% rate of return. And so now all of a sudden you're saying, wow, I can get tax-free growth. Even if it's growing only at 6%, that's probably superior to what I could get in a stock portfolio. Plus I get a death benefit that also doubles as long-term care. And so this is why I think for people that you're addressing day in and day out, the IUL becomes a very, very compelling alternative for people that are growing money in that taxable bucket.
Yeah, absolutely. And that's 9% net of fees. So
that's right.
If you have an advisor doing that for you, then you still have to account for that. So
that's right.
Yeah. Well, shifting a little bit. So we talked a lot, I know in your book, about kind of the tax ramifications, as well as, some of the strategies that you look at. What's your thoughts on building a team for professionals? So, financial planning a lot of times doesn't take just one person to be able to exhibit the best experts. Who do you like to include on your team when you're working with clients?
Well, I think you have to have like-minded professionals. Not all CPAs, for example, buy into the tax-free paradigm. So think about what CPAs do. They're in the business of saving you taxes today. They know that they have a higher likelihood of keeping their job if they can, say, get you a tax refund at the end of the year or help you maximize your tax deductions on the front end. Well, guess what? My particular view of the retirement universe is not necessarily focused on maximizing tax deductions at historically low tax rates so that we can postpone the payment of those taxes till a point sometime in the future. So I think having a CPA, if you're interested in shielding yourself from the impact of higher taxes, having a CPA that's cognizant of that paradigm or cognizant of the fiscal landscape of our country moving forward, that also believes that tax rates in the future are likely to be dramatically higher than they are today. I think it's important to have those types of people on board. Same as far as attorneys go. I think it's just important to make sure that this team that you're building around you is like-minded, that they're on the same page when it comes to, because the Power of Zero tax-free paradigm is diametrically opposed, if you will, to the tax-deferred paradigm. The tax-deferred paradigm, get all the deductions that you can today because you're going to be in a lower tax bracket in retirement. That's exactly the opposite of how we see things going down over the next 20 to 30 years. And so you need an attorney, you need a CPA, but you need these people to all be on the same page. And so I usually recommend you giving a copy of The Power is Here to them and then just standing back and seeing how they react, right? And a lot of people read that book and they have an epiphany and they change right there on the spot.
Yeah, well, it's certainly interesting in the forward to have Ed Slott on there. That certainly helps give some gravitas to the book. So his
Right.
opinions are always well respected in the CPA landscape.
Right. No, and people say you're probably familiar with the white coat investor
Mm-hmm.
since he runs in the same space. He'll say, name one retirement expert out there that is in favor of cash value life insurance. I'd say I'm happy to, and I quote Ed Slott. He's got a whole PBS special on why cash value life insurance can do some things that nothing else can do. He says the cash value life insurance and Roth IRAs will do more to minimize or eliminate taxes from your retirement plan and from your heirs, from the taxes your heirs would have to pay than any other combination of investments. And so Ed Slott is very ahead of his time when it comes to those things, which is why I asked Ed Slott to do the foreword for my book.
That's perfect.
Okay, folks, that was part 2 of my interview with certified financial planner professional Brent Bowden. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head on over to powerzero.com and opt into my free 3-part video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.